Hey guys, James here with Waterford Business Solutions, and today I wanted to go into a discussion that we have a lot with clientele, talking about loans and how it's going to affect your business cash flow and how it's going to affect your business taxes. A lot of clients always get confused on this and don't quite understand how everything works here. So I wanted to take some time and talk about some myths and talk about everything that we see here with loans and everything like that. I do want to invite you before we get started here to go ahead and like and share this video and go ahead and follow us here on YouTube to continue getting content just like this to help you better understand and grow your business. That's what we're always here to do and always want to make sure that we help you provide there. With that being said, let's go ahead and dive in and take a look at how loans affect your books and do a kind of live action walkthrough today in one of our QuickBooks accounts. So as you'll see here, I've gone ahead and gone into my chart of accounts here in this QuickBooks Online account. Ultimately, it doesn't matter whether you're using QuickBooks Online, QuickBooks Desktop, Xero, Bench, Peachtree, Sage, any of those platforms, loans are going to work exactly the same way. And you'll see that down here, I've got several long-term liabilities on here. The first thing to understand with a long-term liability is what that exactly means. And what that means is this is debt that you owe. This is money that you're going to have to pay back in more than a year or more. So anything that's a short-term liability or current liability is due in the next 12 months, whereas a long-term liability is going to be due in 12 or more months. So whenever you go and you get a vehicle loan or an equipment loan or any type of typical loan, those are typically going to be a 2-year, 3-year, 5-year, maybe even 7-year loan if we're staying between material, equipment, vehicles there. If we're talking buildings or something, we may be even going all the way up to 20, 30-year loans there. Or if you're getting an SBA loan, they may be a 20, 30-year loan. And when we get this loan, we're going to go ahead and add this to the books as something that we owe. When we receive that money, it'll depend on what it is that we're getting for money here. It's not going to affect our profit in the company at all. It's never going to touch our profit and loss statement because it's not money that we are making. When we're getting a loan, we're just getting some type of money to increase our assets. Now, we could do that in one of several ways. You'll see that I've got a lot of loans down below for vehicles, and you'll also see correlating vehicles up here. These loans aren't directly influencing or affecting our cash flow in any way, shape, or form because these loans, all they are doing is providing us capital to buy this physical asset. So we're not getting any new money in the bank account. We're not getting anything up here to run off of. All we're doing is getting money to acquire this asset. Now, the goal of acquiring that asset is that that asset is going to allow us to produce more revenue in the long term to help pay for that loan or to replace an aging asset that is costing us too much to maintain. But again, it's not directly influencing or increasing any of our money or any of our cash flow at all because we're taking that immediate money and sinking it into a fixed asset or a physical asset. We're not going to get any money out of that loan until we sell that vehicle asset or whatever asset it may be. Typically speaking, when we're getting a loan for a vehicle, for machinery, for equipment, whatever it may be, those loans are always going to be something that there's never really any cash value in it because when you go to sell that asset, it's always going to reduce in value or depreciate, as we call it here in tax and accounting language, where it's not worth nearly as much as what you paid for it. Now you'll notice, let's pick on this in particular asset that I have here, this Ford Lightning. I've got it valued as an asset on my books for $65,000, and I've got a loan for it on my books here for $50,000. That means I've got $15,000 of positive equity in this asset. So in theory, if I was to go sell this vehicle and I was to sell it for $55,000, I would have $5,000 of positive cash flow from selling this vehicle. However, most vehicles are going to depreciate by about 20 to 25% in their first year. And this particular example, being an electric vehicle, will be on the upper end of that spectrum there. So, more than likely, on that $65,000 vehicle that I'm showing you here, we're going to lose well over $12,000 to $13,000 just in the first year of owning this vehicle. So it's super important to understand getting a loan for a vehicle isn't really increasing the cash. It's not giving you any working capital. Now, there are loans out there through many different companies, whether it be big ones that you're used to hearing like On Deck, or whether it be smaller ones like maybe getting something from the SBA or getting some private lending or something like that that can give you working capital. Now, a working capital loan, that will, yes, increase your liabilities. You've got to pay that money back at some point, but it will also go ahead and increase the money in your checking account to give you physical cash to work with over the next few years. You still have to pay that money back, whatever the payment period may be, maybe 12 months, maybe 18 months, maybe 24 months. Typically, working capital loans, unless it's through the SBA or through your bank there, are going to be much longer or much shorter loans there, where they're typically only going to be for 6 to 24 months is what we typically see there, unless you're going through and getting a physical business loan and going through a very lengthy underwriting process. It's going to give you a lot of cash up front, but you need to make sure, just like any loan, that you can budget that into your business profitability. Again, if you are only eking out $2,000 of profit a month, but if you have to now spend $4,000 a month to pay back this loan, you're going to be negative cash flow there. So whenever we're looking and considering of taking out a loan, we want to understand what your typical net profit, your typical positive cash flow is in the company, and then pull everything out there. And that net profit is one thing, where net profit is telling us how much you're making through the company. Positive cash flow is talking about after we cover all of our cash out expenses, after we cover any loan payment liabilities that we have, any type of credit card minimum payments that we have to cover, any type of tax liabilities, payroll liabilities that we have to cover, what is our cash at the end of the month there? So that's going to be a big thing that we have to consider when taking out loans. A lot of businesses do not consider that when they are taking out a loan, and it ends up harming them or getting them in trouble because they're not taking into account that the cash flow that they have currently, whether it can sustain the new loan payments. Now, ultimately, one part of the loan will show on your P&L and will count against your net profit, and that will be the interest charged on a loan. Whenever you get a loan, there's an APR associated with it. And generally, it's going to be, unless you're buying a vehicle or getting a manufacturer buy down APR, it's going to be in a 3 to 18% category there, depending on your credit and several other things. That portion of interest will always go to paying down the loan, paying down everything kind of going on there, but the interest will show on your profit and loss and affect your net profitability. The principal, which is everything outside of whatever that interest rate is going to pay down this liability. That does not affect your profit, it just affects your cash flow, and thus gives you less cash at the end of the month. So you should always know before taking a loan exactly how much net profit you have, but also exactly how much positive cash flow you have in your company to ensure that it can cover what you are required to pay on the loans that you're taking out. Otherwise, over time, you will put yourself upside down and have to continue taking out more and more loans in order to pay back the old loans and end up in a spiral of never-ending debt. And that's the last thing that we ever want to see. The other thing that I really want to talk about with loans is going to be the tax implications. Many clients don't understand the implications of loans on taxes. And while taking out a loan, it doesn't affect your taxes this year. It's not going to be something where, oh, I took out this $50,000 loan, I'm going to have to pay taxes on it. Paying this loan back is going to affect your taxes. So let's say that this is a 5-year loan, and even at 0% interest, over 5 years, we're going to end up paying back $10,000 a year. So over that 5 years, you're going to pay taxes on that $10,000 every single year as you pay it back, because you're earning money, net profit, and the net profit is taxable, to pay back this loan. Now, in reality, it's a little more complicated than that because there's not very many loans, especially now, that are 0% interest loans. So you're going to see loans where you're going to get less of a tax write-off, or more of a tax write-off in the first year, and then it kind of teeters off as you pay more and more of that principal down because you're paying less and less interest. So in the first year, let's say that we had a 5% interest, you're probably going to pay down somewhere around $5,000, maybe $6,000 of principal. So you're on this loan, so you're going to pay taxes on that $5,000 to $6,000. Second year, you'll pay a little bit more in principal, thus more in taxes, and so on and so forth. When we're talking cold hard cash loans, the only way to avoid paying taxes on it is to spend all the money on that loan each and every year you're paying it back. However, most companies aren't going to do that, and you're going to need the cash flow to cover everything there with the business. That's why it's really important to understand a solid tax plan for your business and make sure you work with someone to give you that solid tax plan. As you can see, loans have a big effect on your cash flow there and can cause a lot of positive or negative issues there. Again, it's really important to make sure when you're working in your business that you're not just taking money out with no plans on what you're going to do with that money. Always have, no matter how low the interest rate, no matter how beneficial that piece of equipment, no matter how beneficial that positive cash flow is going to be, always have a solid understanding of what you're going to do with it to make sure that you're going to get a return on investment on that loan. Otherwise, all you're going to do is continue borrowing money and get nowhere in growing your business. The ultimate goal is always going to be to keep as little debt as possible and only keep debt to grow your business in a productive way. Productive debt is never bad, but debt just to survive is always going to be something where long-term the business will end up struggling. Thank you for joining me today, guys. If you have questions or need help better understanding your cash flow or better understanding your business as a whole, do not hesitate to reach out to us here at Waterford Business Solutions by either giving us a call at 864-351-0852 or shooting us an email at info@waterfordbusiness.com. Please, if you don't mind, liking and sharing this video to anyone who could benefit from it, and leave a comment if you have any questions. We'll be happy to help answer those. Until the next time, have a wonderful rest of your day.